Why is it that you think we may be in a long-term cycle of low interest rates? We're continuing that cycle. We've seen it in the past, but you think it may continue into the future?
Yes, I think what we're seeing is a blip due to the need to fight inflation. So for the moment, we're all obsessed with high rates, although they're not incredibly high, but they're higher than they were. I think this will come to an end. I think we'll basically win the fight against inflation, probably within a year or two. And then we'll go back to something a bit like where we were before COVID, before the inflation. And before the inflation, what had happened for the best of 35 years is that interest rates, what we call real interest rates corrected for inflation, had steadily declined in the US, in Europe, in Japan, everywhere in the world. And my sense is we're probably going to go back to something like this. I think the trend pre the inflation episode was a very strong trend. I see no particular reason for it reversing. So I think we'll go back to something not unlike where we were in 2019, which means very low rates, real rates probably close to zero, lower than growth rates. And if I'm right, then this has very substantial implications for macroeconomic policy in general, but fiscal policy in particular, which is what my book is about.
Well, let's talk about what those implications are for policymakers, because you spend a fair amount of time in the book talking about the relationship between the rate of interest rate on the one hand and growth on the other. And when you're below zero, that is to say the rates actually are lower than the growth rate, it poses particular challenges. What are the risks in having that world, particularly when it comes to investment, public investment?
Well, it's a good world to be in, because you can basically do a lot of things. And if you take on debt, the burden of the debt, which is debt service, is clearly much lower. So this is a world in which there is a lot of fiscal space, to use that expression, which is quite popular these days. When the interest rate is less than the growth rate, you can actually run what we call primary deficits, which are deficits not counting interest rates, and still have debt to GDP, which is the ratio that everybody focuses on, be stable. So there's much more fiscal space. And you can use deficits, and by implication, debt, as deficits accumulate into debt, for things that you need to do. So, for example, if there's a COVID crisis, or we need to spend more on defense for Ukraine or so on, then there is a space to do it. So you use the word challenge. I think it's more a favorable situation in which basically we have the room to do things, and we should use it carefully, but we have the room.
You speak at one point in your book about the fiscal headroom being perhaps nearly infinite. That is to say, you can have a primary deficit that runs without getting the balance between debt and GDP out of kilter. Is that right? Do we have much room? Because as you say, right now we're hearing a lot of people on Capitol Hill, but also at the other end of Pennsylvania, even at the Fed, talk about the risks of too much debt.
No, we don't have infinite room. I want to be absolutely explicit about this. So there's such a thing as too much debt. But the dynamics of debt, when you have interest rates which are low, and indeed interest rates which are lower than the growth rate, are extremely favorable. So you can sustain fairly high levels of debt, and debt service is not a major burden. Now, this being said, you cannot do anything. You can, I think, for example, the Biden last year's big $1.9 trillion plan was excessive. And if there was more of this in the future, that would be an issue. So the point is, there is room to use that if needed, but it should be used right. And I don't think at this stage that the US is on the right trajectory. There's a lot of uncertainty, but there seems to be a willingness to spend on things which are probably not absolutely essential. And this I disagree with.
So let's go to an instance you refer to at the end of your book, actually, where the debt got to be too much, and that happens to be Greece and what happened with the European crisis recently. What keeps us from being Greece?
Well, what basically the belief by investors that if they hold the debt, they'll be repaid, right? So, when you have debt at say 100% of GDP, and investors start having doubts about whether they're going to be paid, they are going to ask for a very high interest rate, say maybe 5-10%, right? In which case you have to actually take 10% of GDP every year in order to satisfy them, something you can absolutely not do for political and other reasons. So in this case, they're self-fulfilling doubts lead to a debt crisis. And that's more or less what we saw in Greece. They just had too much debt. They just could not handle it. In the US, if you do projections, they can be scary, but you know that the political process will eventually kind of adjust, even in the US, even if it's broken. And so I think we have room to have the levels of debt we have today. Again, if we were to keep doing this forever, at some stage I would worry, but I don't worry today. If I'm an investor, I say, what is the probability that it will be repaid in, say, 5 years? If I hold a 5-year bond, I think it's one. And so therefore I'm willing to basically lend to the US government at very low rates. So there are differences across countries which come from the political process, the level of debt, the uncertainty, the maturity of the debt, and so on. I think for the moment, there's no reason to worry about debt, but that's not an excuse to have an irresponsible fiscal policy.